Hello, everyone, and this session is being recorded. And sorry for the late notice that I finally decided to put this session online for various reasons. One of it was that I was originally thinking about my family, but I realized that everybody else, you guys probably have some kind of trouble gliding through the Halloween without taking the kids to trick or treat. It was, I don't know. Just thought it might be good to make it a little flexible this time, just this time. Okay. So as we planned, we're going to talk about the valuation of stocks and corporations, especially in the part of the discounted growth model, discounted dividend growth, dividend model, or alternatively, you can call it the constant growth model. So the slides, however, contains another part called the free cash flow model to evaluate equity, which we will cover towards the end of the semester. So depending on how much time we have. Okay, so we are going to aim at looking at probably around the first 30 to 40 slides, and then I'll probably summarize it at the beginning of the next class as well. So bear with me, because in this case you cannot hear you can hear my voice, but you cannot see me. You cannot see any of my gestures. I try to be as clear as possible, but we can save the question for later, apparently. Okay, so as normal, as usual, we're gonna start with the concepts. So, well, we talked about corporations, and it represents the ownership, and the stocks actually represents the ownership and the control. So, this chapter does kind of briefly mention some other kind of stock that does not gives you control, but in general, the stocks actually has control because the stockholders in the real world, especially the block holders, which means stockholders like Warren Buffett, who has a large share of the whole corporation, they tend to have control over the process and the result of the directors' election. So the board of the directors, then they are charged of the task of finding the proper management, and the managers are the ones what we call the CEOs. Okay, so and there is classified stocks. Some of them have special provisions. Okay, but we're not gonna go very deep into it. There are tracking stocks and classified stocks, but we just talk about usual common stock right here. Okay, so the usual different approaches for evaluating common stock is, first of all, the dividend growth model and the free cash flow model. So, of course, you can use the multiples of the comparable firms, which I think you will perform in your second case as well as in your term paper as well. So all these three different approaches you are going to use for a term paper, but specifically this one, the first one, the dividend growth model, is going to be covered today, whereas the multiples of comparable firms is a very simple concept and an extension from what we've learned in chapter 2 and 3. Okay, so constant dividend model, as you can totally imagine, why do we focus on dividends? Well, first of all, the dividend is the real cash flow that someone will actually receive. Is equal to the cash flow received by shareholders. Okay, so this is annoying. I need to bring it over. And as we all know, the second concept that is underlying or implied by this logic is that you are going to evaluate any kind of security. Financial security evaluation means that you are going to look at the sum of the present value of all future cash flows. This one we talked about earlier in chapter 5, in the fixed income chapter, when we talk about how we evaluate a bond. Okay, so the fundamental difference between a bond and the equity or the stock is that the bond has a fairly stable or clearly structured cash flow stream. So for the bond, everybody understands it's going to be coupon, 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 and then the principal at the end. However, for the stock, if you're going to hold a stock, first of all, there is no natural end. You can hold a stock conceptually or theoretically. You can hold a stock forever because the stocks will last forever. Remember when we talk about a corporation in the first chapter, corporations has infinite life, right? So that is a fundamental difference because you can say, okay, for the bond, naturally, even if you don't do anything, you don't sell it, at the end there will be an end. That's when you actually get the principal. For the equity, however, you will have to decide on your own end, and the stock itself does not stop. Does that make sense? So that stock, the structurally, is going to be last forever. But you can decide to sell it to another person. That means you are just going to sell. That means you're just going to sell the present value of all future remaining cash flows to the other person. Okay, so now we understand that the dividend is the cash flow received by the shareholder, and security evaluation involves calculating the sum of the present value of all future cash flows. Then the natural combination of these two is that we will have to evaluate the stock value, or alternatively equity, by the sum of present value of all future dividends. Okay, now this one is a lot harder than the bonds, at least at this current level. Why is that? Well, for the bonds, you actually have a promised amount of coupon that's written in the contract. So the contract says, hey, I'm going to pay you 5% coupon. And they are supposed to pay you 5% coupon, otherwise you can sue them, you can push them into bankruptcy. Here for the stock, however, the stocks don't always promise you any dividend. Okay, so they just try to keep a fairly, even for the so-called the blue chip stocks, excuse me, that they are oftentimes trying to establish a long, stable, steady stream of dividends that is paid to everyone, so that everyone will believe that they will keep paying. Does that make sense? There's no formal contract or anything that's really put into the paper and say, every year you have to pay me this, 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 and this dividend. And there's no such thing. So in order to evaluate the equity by the sum of the present value of all future dividends, first of all, well, you don't know what kind of future dividends you're going to get. And you don't know when will they start paying dividends if they're not paying any right now? Well, first of all, if the company is currently not paying any dividend, then we will have to go to other approaches. For example, the discounted free cash flow approach to evaluate the equity. If, however, the company is paying a steady stream of dividend, we will try to do a projection on the dividend stream into the future infinity and try to evaluate it according to our assumptions. So basically, in order to do it right now, we have to make an assumption of how does the dividend dividend stream evolve, right? If it's a random kind of series, then it will drive people nuts. Because how are you going to evaluate a random stream of infinite amount of dividends? It's just a mission impossible. So you have to, even if a lot of times it's a little bit scattered, the dividend is not following a steady stream, in order to make sense, in order to be able to evaluate it, you still have to use a certain kind of assumption, make it into a steady stream, and hopefully will approximate the whole stream in the future. Okay, so just want to point out a few caveats here so that we don't think ourselves as almighty god of the stock market, that we know how to price everything, and it is a very crude, very preliminary kind of attempt to get an idea of the intrinsic value, and we can build from there. So what kind of assumption you're going to do depends on exactly on the firm that you're looking at. But in general, you are going to assume that the dividend is going to be growing at a constant rate. So here we call this constant rate G, the growth rate. Kind of makes sense, huh? So sometimes this growth rate is greater than the required rate of return. Remember, we talked about in last chapter, what is the required rate of return? Well, according to the CAPM, that part of the risk is priced, part of the risk is not priced. The part of risk that is not priced is called idiosyncratic risk, and the part that is priced is called systematic risk. The systematic risk is the part that's going together with the market risk, and because that part cannot be diversified away, it should be just one moment. It should be rewarded by a proper premium or proper return difference, an additional return. Make sense? So with the market return, add on to this additional premium, the market premium, risk premium, which is which gives us the risk-free rate plus market risk premium. That will give us a proper gauge of what kind of return is required in the market for people to hold on to this specific stock. Or alternatively, the kind of the return that is required in the market for people to be willing to invest at this specific risk level. Does that make sense? So the required rate of return is determined in the market and imposed onto this specific firm. And the growth rate, on the other hand, is the rate of growth of the dividend that the firm is able to perform. So those are two different things. Okay. Then sometimes the growth rate can be greater than the market required rate of return. Sometimes the growth rate can be less. So if the growth rate is less than the market rate of return, then people are not going to invest in this firm. And that means the firm will not grow. And over the time, the firm will just go away, because if nobody wants to invest it, then there will be less and less shareholders, and less and less capital available to this whole firm, and the firm value and the equity value will both diminish. So if in order for a firm to exist and to last for a while, it has to grow in a rate that is higher than the required rate of return. And I hope this one makes sense, because, well, anytime you want to invest anything into a company, all you want is to invest in a profitable kind of investment that can give you a return that is higher than anywhere else you can find, right? So if that return is lower than the market expectation, then of course people steer away from that specific firm, and things just doesn't go well. Okay, so in this chart, it tells you in a figurative way and say, okay, D1 grow into D2, grow into D3, and so on and so forth. If it's going up and up and up at a rate of G, and then G is higher than the required rate of return, then everything makes sense. However, if it goes lower and lower, lower, or sometimes even G is less than 0, less than 1, or is less than the required rate of return, then things don't go well, and things go away. And after we understand this concept, let's come back and look at how we calculate it. Well, basically, it's the same thing as compounding, but instead of compounding at interest rate, it will be growing at a growth rate. So we're going to compound it at G right here. So we compound it at a G and discount it at the required rate of return. This is going to be the present value of any specific dividend that's paid at T. Okay. So if we look at the whole stream of the future dividends, it will basically be the first dividend, second dividend, so on and so forth, until the infinite amount of dividend. And you're like, how are you going to calculate a summation over a stream or a series of infinite amount of items? Well, there is, if you have certain simplification going on, and I don't want to present you the proof, but if you're really curious, I can give you a proof in my office. If you come to my office in my office hour, I can give you a proof in about 3 minutes. It's not a big deal, but I just want to make sure that everybody understands this whole summation here, with 1 plus G on the top, 1 plus the required rate of return on the bottom, and blah, 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 blah. Okay, we'll come to a nice simple form that looks like this. Okay, so this whole stream then converges to this one. And notice that on the top, you still have 1 plus G, kind of makes sense. And the bottom here will give you the difference between required rate of return and the growth rate. Okay, so this is mathematically how we get it. And if we define, of course, the next period dividend, the D1, as the current period dividend multiplied by 1 plus G, basically current period dividend growing in 1 year, that will give you D1, the next period dividend. So if we want to know the current period price, we need to use the next period dividend. Does that make sense? So if you want P0, then we're going to put D1 on top. What about if we want P1? Yeah, then we need to put D2 on top. And if we want P3, we want to put D4, and so on and so forth. Okay. Okay. So as an example, we are going to look at this specific case. It says in order to get the required rate of return, we know that the beta is equal to 1.2. We know risk-free rate is 7%. Market risk premium is 5%. So according to CAPM, or we just use the security market line, which is the line or the graphical representation of CAPM. CAPM, capital asset pricing model. Okay. Then we're gonna calculate the required rate of return equal to risk-free rate plus the market risk premium times the beta. So the beta tells you how much is the systematic risk. Risk premium of the market tells you how much is the return the market is getting on top of the risk-free rate. And then you put that together, tells you the required rate of return is 13%. Okay. So also given is the current dividend $2, the required rate of return 13% from the previous slide, and then the growth rate is 6%. So to calculate the price right now, we put in the current D0 multiplied by 1 plus the growth rate 6%, okay, divided by the 13% minus 0.06. So the $2 D0 times 1 plus the 6% growth rate is 2.12. You plug that into this part, gives you 2.12 divided by 13% minus 6%, you get 30.29. And that is what we call the discounted dividend model, the DDM. Alternatively, we can call it a constant growth model. Okay. So, in general, the price at the T will be equal to the next period T plus 1 dividend divided by RS minus G. Okay. So what if we want to calculate D2? D2 then is D1 times 1 plus G again. So that is equal to 2.24.72. And that will give you 32.10. And P0 is going to be 30.29. And P1 should be P1 here. Okay, it will be 32.10. And the dividend yield then it will be the next period dividend. If you start holding right now, over the next year, you're gonna get the D1 as the dividend income. Okay, what is D0? D0 is the last dividend that you've already paid. So the next year, whole year, you're gonna get 2.12. Take that, divide by the current price, 30.29. That will give you a 7%. This is what we call the dividend yield. So the dividend yield is kind of conceptually is like current yield in the fixed income in a bond. So constant growth yield then is the P1 minus P0 divided by P0 as a verification, okay, is equal to 6%. The total 1-year return then can be decomposed into the dividend yield and the capital gains yield. So basically the total return we are requiring here is 13%. We assume that the market will be traded, the stock will be traded at a price that just satisfies this required rate of return. So that 13% of the required rate of return is partially coming from the dividend yield 7%, is from how you're going to get the dividend, and partially coming from the capital gains yield 6%. Okay. That is a very, very overly simplistic calculation because very few stocks will be growing at a constant will be growing at a constant speed like forever. That's why a lot of times we look at it and we are going to see a lot of patterns, and some of them will grow for a few years and then stop, and some of them will grow for a few years and then keep at the same, be stagnant, and then start declining. So suppose the current stock price is 46.66. The present value of dividends beyond year 3, with all the present value of all dividends in the future after year 3 is 39.22. Then the percentage of a stock price due to the long-term dividend is going to be 39.22 divided by the current stock price, that is 84.01%. So this one further illustrates the logic of the short-term and long-term cash flows. So in the short term, you're going to get first dividend, second dividend, third dividend. The present value of each dividend discounted. Okay, if you add all these present values, that's going to give you $5.29. And among $5.29, the price is 30.29. So it is the part of 30.29 that's due to the sum of the present value of the dividend is 17%, and rest of them come from the long run. Okay. So if things are so simple, why are the stock prices so volatile? Well, because as we can see, we are having as a denominator the difference between required rate of return and the growth rate. So when that difference gets very small, a very little change can make the whole price volatile a lot, change a lot. And as the whole thing, as we can see in this illustration, we have the growth rate plotted out at 5, 6, 7, required rate of return 11, 12, 13, 14, 15, and we can see the price actually varies a lot, all the way from $21 to 53.50. So more than doubles, right? And remember, what is the required rate of return? There is no carved in the stone rule for required rate of return. It's still a theoretical value that we get from a capital asset pricing model. So this is a theoretically implied kind of essence, a rule of thumb you get from the market, and the growth rate is your own forecast that a lot of times come from, some iffy data that has a lot of potentially earnings manipulation. So as you can totally guess, since these whole things, these inputs can be so not accurate, let's say, and the whole thing becomes more of an art than a science. So we can see why it is being so volatile. On the other hand, even if everybody's using the state-of-art models, and when the information comes out, people will gradually update their estimates of the growth rate and return, and that will make the whole thing volatile as well, because they update while they update their estimate, they will start trading, to start realizing all those values. Okay. On the other hand, we can rearrange the whole model to look at everything from the return point of view. So remember, we talked about in the bond, we can look at things in a price point of view, and we can look at things in the yield point of view. So here, we can also look at the whole thing as the rate of return form. So we start with the dividend, this constant dividend model, this constant growth model, and we solve for the required rate of return or expected return. And on the left-hand side, the RS here. Then on the right-hand side, we are going to take the dividend, the current price, and plus the growth rate. So basically, the rate of return should be equal to the dividend yield plus the growth rate. Okay, that should be equal to 13%. But notice there is a subtle difference here. In this part here, in this part in particular, we're assuming that the required rate of return should be equal to 13%, and we're trying to infer the price from there. However, in this version, the second version, we're assuming we know the current price in the market is $30.29, and we infer the corresponding rate of return. Okay, so that covers the basis of constant growth stocks. What about it is not a constant growth stock? Okay, so before I got into anything else, let's look at a very quick and easy case of preferred stock. Okay. Preferred stock is, first of all, a hybrid security. So why is it hybrid? It's similar to bond because it has a structure. It has a fixed dividend as written on a contract. However, it does not have the power of the bonds, so the preferred stock can be omitted without fear of pushing the firm into a bankruptcy. So in that case, you kind of get the worst of both sides. Then how you calculate the preferred stock, we talked about it before. This is basically evaluation of an annuity, knowing the payment. So we are going to take the dividend, divide by the required return of the preferred stock, and that will be equal to 30. So why do I want to mention it right here at this moment? It's because I want you to realize that the preferred stock is just a constant growth model with the growth equal to 0. That makes sense? If we look at this whole thing, okay, instead of having growth equal to 6%, if we have the growth G equal to 0, then we don't have this whole part anymore. And then we are left with the dividend 2.12 divided by the required rate of return 0.13. And that's exactly how we evaluate preferred stock, because the preferred stock has a dividend stream that does not grow. The growth rate is 0. Okay. Now everything makes sense, except for, as I said before, a lot of stocks do not have a dividend that grows constantly. What if the growth is non-constant? So for example, if we can have from year 1 to year 0 to year 1, 25%. Then the next year, from year 1 to next year 2, 15%. Then another year, you get, the first one 30%, then 25%, then 15%. And then after that, a long run constant growth of 6%. Okay. So this is actually very normal. Because for one thing, this whole thing over here, they are oftentimes what we observe in the market. Very few firms grow constantly, but as we understand that there are several stages of the firm, there are starters, there are highly growth ones, and eventually there are the cash cows. The cash cows are in a more of a steady kind of state, and we can look at a lower growth rate, but kind of it's steady in the long run. But in the first several years, these companies could be growing very fast. So in that case, since in the first several years we do not have a steady growth rate, we can no longer use the constant growth model. But at the end, it will become a constant growth after 3 years. So if I'm going to draw it out, right, we're going to have year 1, year 2, year 3, and then every year after is going to be constant growth, and so on and so forth. If we take a look, if we put our eyes specifically at this point, oh, that kind of looks cute. Okay, so if we take a look at that point, okay, and the value that we're going to receive will be a regular constant growth stock value. Does that make sense? So that using that, we can calculate what we call the horizon value right here. This is what we call the horizon value, which is the value of a constant growth stock in the long run. Okay, so to calculate the horizon value, we use the same dividend discounted model, except for the growth rate is the long run growth rate, the GL. Okay. And then we are going to take the year 1, 2, 3 dividends individually. So if we take today's dividend and get next year's dividend, we get D0, okay, $2. Growth in the first year, $2 times 1 plus the first year growth rate, 30%, you get 2.6. Then we take 2.6, multiply by the second year growth rate, 25%, and we get 3.25. Then we put 3.25 into D2, then multiply at the growth rate of the third year growth rate, 15%, we get 3.7375. Now we are going to use that dividend as in to calculate the last dividend. So this is D3. We're gonna use that in this one. Okay, remember D4 is calculated from D3. So we take 3.7375 multiplied by 1 plus the long run growth rate, 6%, and divide by the return minus the long run growth rate, and we get that at this point the horizon value is 56.596. So namely, we put an I in here, and at that time we see that the price should be 56.596. Okay, so if we are going to discount all the values that we're going to get, the first year we discount 2.6, the dividend. Second year we discount 3.25. Third year we are going to discount both the dividend and the horizon value here. And after we calculate all the discounted value, sum it all up, we get the current price of 46.661. Okay. So in the dividend yield, in a sense that in next year, the dividend yield will be 2.6, the first year's dividend divided by the current price 46.66, we get 5.6%. And the capital gain yield then is the rest of it, 13% minus the 5.6, which is 7.4%. Okay, so I'm going to stop right here, and next time we are going to continue and start talking about the free cash flow. Oh, actually, free cash flow is for the end of semester. Next time we're going to have a summary of this one and make sure everybody's on board. Okay. And see you next time. And don't forget to do your homework.